Hello, and welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. On the show, we're going to cover key opportunities and risks for investors tied to developments around the world, and we take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time. We'll get to those questions in a few minutes after we share some of our latest insights. We actually have relatively few of them prepared for today to give you more time to ask your questions today. So we've devoted more of the show today to your questions. I'm really looking forward to that. So go ahead and get those in. We'll be getting to those in a few minutes. Now, let me give you a few required disclosures, though, before we get started. We don't know you personally, so we don't make personalized recommendations, but we generally talk about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why, though we don't provide an outlook for specific stocks. And things, of course, can and do change, so everything that we share here is subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team here at Charles Schwab. Hi, Michelle and Heather.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody.
So I know, Heather, you're going to be watching those questions very closely in the chat, and we'll get to those in just a little bit. Again, I've set a lot of time for your questions today, so don't let me down. Get those questions in. Again, you can enter them in the chat on YouTube at any time. We'll probably get to those in about 5-10 minutes or so. I'm going to kick things off as I usually do with what I am watching this week, and then Michelle, you can chime in with anything if it's on your radar screen. We talk about this stuff all the time, but you may have some extra things to add. First of all, the earnings season is wrapping up. We all know that Q3 earnings season generally is over for the most part, but there are some big names that have fiscal third quarters that end in October. A lot of retailers have fiscal third quarters that end, partly because big holidays like Christmas, you want to wrap that into January as well, right? You kind of want to smooth that sales pattern out. So a lot of them do that thing where their fiscal quarters are off the calendar quarter by 1 month. And so we're gonna hear from some of those. We're gonna hear from like Walmart and Target and BJ's and Lowe's and TJ Maxx and Gap, where they'll probably talk about pretty good back to school demand, but the real focus is going to be on what do they expect for the holiday season. The consumer seems to be increasingly price sensitive in the U.S. We'll see what that means in terms of their mix and what they expect from the U.S. consumer, which is, of course, very important to the global economy. And then we're also going to hear from the biggest stock of them all. NVIDIA reports this week. So there'll be a big focus on that, mostly on guidance for new AI chips and if there's any supply issues or anything like that. Just the market's so keyed into that as a theme with the biggest stock, NVIDIA. That'll certainly be an attention grabber this week. I'm trying to think what day they report. I think it's Wednesday, but don't quote me on that. Sorry, slipped my mind as to which day they actually report. We're also going to get CPI inflation reports from Canada and the UK this week, and both are expected to rise. As we saw in the US CPI report last week when it rose to 2.6 in October from 2.4 in September. Canada's October CPI reports due Tuesday, and it's likely to show that annual inflation is now at 1.9% compared to September's 1.6, still below 2, but kind of creeping up a little bit there. And on Wednesday, we get the UK CPI report to show inflation probably picked up to 2.1% year over year, above the Bank of England's 2% target from 1.7 in September, largely on what's a temporary rise in energy costs, we think. But it's interesting to note, we've seen generally inflation coming down over the last couple of years. Now we're starting to get these little upticks. Probably volatility, but we have talked about how inflation is going to be more volatile and probably higher on average than it's been the last couple decades. And we're getting a little bit of a taste of that now. And of course, that has implications for what central banks may do. On Friday, we're going to get the latest reading on the global economy with my favorite piece of economic data that comes out every month. It's the preliminary version of the November business surveys known as the PMIs, the Purchasing Managers Index, comes out for the US, the UK, Eurozone, France, Germany, Australia, Japan, and India. We get for more countries on the first of every month, but this is the preliminary reading where they get like 90% of the survey responses in and they release that like preliminary version. It's for November, so it is one of the most timely surveys we get on what's going on in the economy and the earnings picture. And last month, it signaled a decline in manufacturing activity in the fourth quarter, as it was getting underway in October. For most major economies, even in the U.S., where there's talk of U.S. exceptionalism and booming growth in the U.S., manufacturing PMI in the U.S. came in at 48.5. That's the fourth month in a row below 50, which is the dividing line between growth and contraction in manufacturing. So we'll have to see if there's any lift to business sentiment following the decisive U.S. election outcome that put to bed any lingering uncertainty as to the outcome. So there could be some businesses who were waiting to see what that outcome was before they put in orders or they expand operations or do some hiring, just to know what the lay of the land is, and they may feel a little bit more committed to making those decisions now that the outcome is known. Last week, we talked a lot about the election impact after previewing it for about a year. And one of the biggest movers was European automakers. These stocks, including BMW, Mercedes-Benz, and Volkswagen, are among the hardest hit since the U.S. election. And I'm going to be watching them this week. They fell 7 to 9% last week, or really 7 to 9% since the election. So since Tuesday, they're down quite a bit. Now, in 2018, President Trump tweeted that he planned a 20% tariff on all cars coming into the U.S., but he dropped the idea after he met with then the European Commission President Juncker, and they kind of scrapped that idea. This year, though, Trump has revived the idea of very significant tariffs, quote unquote, on vehicle imports. And one reason is the large trade surplus Europe has with the U.S., and another is that the EU tariff, Europe's tariff on US cars is 10%, but the US tariff on European cars is just 2.5. So to even that out, it seems like a rise to at least 10% on European auto imports seems pretty likely. But what does it really mean? A 10% tariff on cars may have little impact on German car sales in the US. The 5% rise in the dollar versus the euro, I mean, it's already up 5% since the start of the fourth quarter, may offset much of an additional 7.5% tariff, right? So if the dollar's worth more versus euros, and then the tariff goes, it's a bit of a wash. In addition, you get these European car makers already having substantial U.S. operations, so that might mute how high they're likely to go. And it could be an opportunity for a rebound in some of those stocks. So I'm watching those stocks very closely this week. They're not a huge part of the European stock market, but they are a big part of what Germany does. Germany, the biggest economy in Europe, very tied to automaking. So I'm very focused on that. Michelle, what do you think?
Yeah, I mean, I think if we step back and look a little bit more broadly, the risk really might be more to Canada and Mexico as well as China rather than to Germany. We have a chart of trade between the U.S. and these other countries. And the reason that I say this, it's maybe more of a risk to these other countries. On this chart, Germany's fourth. And the reason is goods coming into the U.S. are 83% of Mexico's exports, 77% of Canada's exports, 16% of China's exports. Well, if we look in the other direction in terms of goods from the U.S., 18% goes to Canada, 16% to Mexico, and 8% to China. If we focus on Germany a little bit more, though, they kind of have something else more to contend with more near term, which is that they're what they call a traffic light coalition. That's named for the red, yellow, and green colors associated with the three parties, the SPD, the FPD, DP, and the Green Party has fallen apart. And this collapse was triggered by a disagreement over fiscal policy, as well as the waning popularity of all three parties. Now, at the center of the disagreement was that the finance minister from the FDP party wanted to stick to the strict fiscal rule, what they call the debt brake, while Chancellor Olaf Scholz of the SPD party wanted an emergency suspension of the debt brake justified by the war in Ukraine. Now, next up is a confidence vote for Scholz, which he's likely to lose on December 16th, and that'll set up for an election in February. So Germany's in for a little bit of uncertainty here in the near term, but there are some potential silver linings. And the reason is, elections were due anyway this coming September. By bringing them forward, this could set the country up to be in a better position to address both the soft economy and the threat of new tariffs. And additionally, there's a reform about the debt brake currently being openly discussed by both the conservative Bundesbank and the poll-leading SDU party. SDU party is also moving away from its opposition on nuclear energy. So these changes could address two of the issues that have hindered the German economy, which is lack of investment and over-reliance on Russia for energy.
Yeah, I'm trying to even wrap my brain around a country so committed to zero deficits, right? Like, what's that like? But it's been part of Germany's core approach to fiscal policy for so long, and so you've got the sort of sort of the more right-leaning member of that coalition saying we got to stick to this, and the others are like, no, no. I mean, nobody else is. Why should we? And it would just put a drag on our economy. We've talked about Germany was likely to move towards putting that break in place, essentially spending less than last year. And that could be a drag of as much as a half a percentage point off of GDP, not just in Germany, but Italy and France, which also are dealing with these tight budget issues. Half a percentage point off GDP next year. Not enough to tip them in a recession, but just kind of shaving off growth a little bit. But this now loosens things up a little bit, right? Maybe as a result of this government breaking down over this issue, then maybe there's a little bit more spending that gets done. So we'll have to see what happens. It might be less of a drag on their economy. It could be maybe not a boost. We're probably not going to move in that direction, but certainly becoming more neutral in terms of fiscal policy in the Eurozone, which is a plus for growth in terms of the economy and earnings as well. So kind of interesting to see. We've got our 2025 global outlook being published in 2 weeks from today, and we'll really focus and dive into what we really think that means as we get sort of more updates here in terms of the government and how that's shaping up, and when we might see that no confidence vote, and then what's going to unfold after that. But it'll be interesting to see.
Yeah, I think, the other, potentially good news in terms of silver linings for Europe is that expectations for Eurozone stocks are quite low. Eurozone equities, as represented by the MSCI EMU index, are trading just 13 times price to next 12 months earnings. That's a 40% discount to the S&P 500. And that's really a much steeper discount than the 20% average over the past 10 years.
Yeah, we know that U.S. stocks tend to trade at a premium to European stocks, mainly because the sectors are different. U.S. has got a ton of tech, a high PE sector, and Europe's got a lot of like financials and industrials and energy and that kind of stuff. But even when you account for that, we're looking at double the normal PE premium, which is at just historic wide. So it really does suggest that maybe European markets priced for a lot of pessimism. They've been through a recession. The U.S. is not. They've kind of been through that. Earnings are now recovering. The economy is recovering, still growing below potential, still growing a little bit below average, and there's certainly some headwinds there. But things seem to be turning around, and there's maybe room for more PE expansion, and that's one of the things I'm looking forward to next year. We know that when the ECB has cut rates in the past, as they are now, the PE ratio has gone up for European stocks. So that can happen again. I think Europe's picture relatively brighter next year than it was this year. But pivoting back to trading partners like Mexico, and in that chart that you brought up, what do we see in terms of the trade war's impact on Mexico?
Yeah, Mexico is probably one of the most vulnerable economies to the tariffs because it is such a large trading partner with the U.S. and because there's been a wide range of threats made. And unlike Germany and China, Mexico doesn't really have a lot of room for looser fiscal policy. Mexico has also benefited from investment from China for export into the U.S., and that could be at risk. Now, the peso has recently weakened to the lowest level since 2022, and that can help the competitiveness of Mexican exports, but it also poses an upside risk to inflation. So, Mexico's central bank cut rates for the third time last week, but currency weakness may mean it needs to trade off, downside risks to the economy with upside risks to the inflation. We also have the threat of deportation of people back to Mexico, and that could add additional economic weakness. Now, the USMCA, that's the successor to NAFTA, it's up for renewal in 2026, but any country can withdraw with 6-month notice. So Mexico is likely to make concessions and make a deal with the U.S. to lessen the impact. In terms of its stock market, it's pretty small. It comprises just 2% of the MSCI EM index.
Yeah, it's important to keep in mind. Mexico's a huge trading partner with the U.S. and kind of punches above its weight sort of on trade and some economic issues. But from an investment perspective, it is a very, very small stock market and not one that really moves the needle one way or the other. But certainly something we're going to keep an eye on there as we move through a very wild environment for trade policy over the coming months and year. Okay, so that kind of concludes our thoughts that we were going to share today in terms of stuff that we had prepared. So Heather, what do we have in the Q&A? I'm excited to hear what's on everyone's minds.
Well, we've got quite a few questions. I think maybe we'll start with the potential discussion on potentially placing tariffs on Canadian oil imports to the United States. Can you just remind our audiences who pays those tariffs? The US, Canada, somebody else? Can you kind of go over that for our audiences today?
Yeah, sure. So, tariff, it's not perfectly clear ultimately who pays a tariff, right? So, ostensibly, it's the buyer. The buyer actually pays it, but does the seller discount their product a little bit? Recognize, do they bear some of that burden? It depends on the end market. It depends on whether it's a very elastic or inelastic market, how much pricing power the seller has versus the buying power of the buyer. In general, usually some of the tariff is at least paid by the buyer. Anywhere from 100% to 1% is usually paid by the buyer, but it really depends. In the case of a lot of agriculture, energy, materials, there's a lot going on there because there are a lot of different places you could source from, but it's a lot harder to get, for example, oil or timber, a lot of heavy, bulky things from somewhere else around the world than it is right across the border in Canada. So there's that locational advantage. So there's a little bit of friction there. So a buyer may be willing to pay a little bit more, yes, to pay the additional tariff in order to get those products because the logistics costs are that much lower. And that seems to be the case. Every product's a little different. Some of that tariff tends to get passed on. So when we're talking about the potential for the USMCA agreement to now include perhaps 10% tariffs, I'm doubting it's going to be on everything from Canada, everything from Mexico, but there could be selected items to protect certain industries in the US or ostensibly to protect those industries. We could see some of that. So we'll see how that breaks down. I imagine every product will be slightly different and it might even change over time a little bit, but it probably does mean at least slightly higher prices for US buyers. But so little of a finished product cost. For example, what portion of, if you're buying a house, what portion of that is the timber? And then 10% additional price on top of the timber. I mean, certainly it adds to cost and can increase inflation, but it's not huge generally when we're talking about these relatively modest price increases on some of the direct materials, but it can have an impact on some businesses that are very focused on timber. Maybe you're making guitars, right? And you source wood from Canada, and that's a huge part of the cost of what you're producing there. So there are, different industries are going to bear different costs and pass those differently on to customers. There's no one simple answer to that. The buyer technically pays the customs duty when it comes in, but again, the seller could give some kind of a discount in response to that. It really just depends on the product and that particular time period and the relative power of the different actors in the marketplace.
Thank you so much for that. Michelle, you mentioned that Mexico kind of hits above its weight class, being relatively small, only 2% of the EM index. What is our outlook for EM as a whole, given the trade policies that are now coming into question?
Yeah, I think we get the question that should we be avoiding China and EM now? And I think it's, not necessarily the case because, remember that valuation and expectations matter. And Chinese stocks, EM stocks, they're not expensive. If we look back to Trump's win in 2016, it was thought that his America First policies would cause EM stocks to suffer and benefit domestically focused U.S. small caps. But yet, during Trump's term, small caps underperformed, EM stocks outperformed the first 2 years, and that's because the policy mattered less than the economics. And, if we look at EM as a whole, they're in a lot better shape than they were decades ago. And so any kind of crisis, like let's say if we continue to get a stronger US dollar, that's pretty low. EM, in terms of EM, China is 27% of the index. It could struggle as China's economy continues to muddle through. We think it's probably likely to continue to decelerate next year. And because we're getting these hopes about fiscal stimulus wax and wane. But Chinese stocks, they're 10 times next 12 months earnings, and EM stocks are 12 times, right at their 10-year average.
Yeah, it's just to add on to that. It's worth noting, Chinese stocks, if you look at the Seng index, so Chinese stocks traded in Hong Kong, a developed market, they're up 15% this year in dollars. So, that's one of the consequences of the stocks being valued so inexpensively. There's the world-class companies that are, headquartered there that have their shares trade in Hong Kong. And, they've done pretty well this year. Not as well as the S&P 500, which is up like 25% this year, again, led by just a handful of AI stocks. But you're really seeing, strong bounces in Chinese markets. They're kind of having trouble getting pushed lower. And again, it's as Michelle, you pointed out, it's 27% of the index. So what happened, as goes China, so goes EM for the most part. And it seems like it's getting harder and harder to push those stocks any lower.
Yeah, we also have India's weight has continued to increase in the index, and hasn't done as well recently, but continues to have a strong longer-term outlook.
Right.
Thanks so much for that information. Now, we talked a little bit about European automakers and how they may be affected by some new tariffs. Do we have any views on Japan?
Yeah, I mean, Japan certainly sells a lot in the US. They manufacture a lot in the US. So Japan doesn't do a tremendous amount of manufacturing in Japan and then shipping those cars to the US. They generally have factories in the US, so they are somewhat insulated from that. Some German automakers do as well, of course, but Japan's been doing this a long time. I mean, this was a big part of the mid-'80s trade battle with Japan. And essentially, at the time, quotas were put on how many cars they could ship to the U.S., and so they just started building factories here. And so they've been here a very long, it's the mid-'80s, right? It's been a long time. So because Japanese automakers have more operations here, they're less hit by those tariffs. Obviously, there's still parts that are coming in from overseas, including Japan. We don't make everything that goes into a car, even a Japanese car in the U.S. There, speedometer needles come from Germany. There's parts of, cars are rolling computers these days. There's parts coming from all over the world. So it's important to keep that in mind. Doesn't mean they're completely insulated from it, but a little less so than German automakers, which have more recently, maybe in the last 10 years or so, really started to build up their U.S. operations, but there's still a lot. Germany's biggest export to the U.S. is still autos, and that's different. That's not the case for Japan.
Now, switching to some of the expectations of the tariffs to sort of boost the labor market, how are we seeing labor markets respond worldwide?
Well, Michelle, I'll let you chime in on this as well in terms of what you're seeing. Generally, labor markets have held up pretty well, but we're seeing some signs of softening around the world. Now that the services boom, the post-pandemic travel boom, and just services really coming back after things been locked down for so long, that ramp up in wages and hiring seems to fade a little bit. It's come back down somewhat, and so we're feeling that a little bit more softness on the services side. Remember, most jobs are services in the world. In a country like Germany, it's like 4-to-1 services jobs to manufacturing. In the U.S., it's like 10-to-1 or 9 or 10-to-1 services to manufacturing. So as that begins to slow, we're seeing a little bit more weakness there. When we talk about tariffs, we're really talking about protecting manufacturing jobs. They're a tiny share of jobs in the U.S. So don't expect that to be a market mover here or an economic data mover in terms of really changing the prospects for the job market. Employment in manufacturing in the U.S. is equivalent to what it was basically in the mid-1950s. It's just we've grown jobs and services, which pay more generally than manufacturing jobs do, and that's where we want to go. Other economies around the world seeing a ramp up in manufacturing, starting to see more hiring in manufacturing. That's helpful, but of course it does the prospect of tariffs and the negative impact that could have on manufacturing in other parts of the world that are dependent upon sales to other countries. That could weigh on their labor markets that are, again, a bit more tied to manufacturing. So we'll have to see how that shapes up, but probably not going to be much of a mover here in terms of U.S. employment. Michelle, do you have anything to add?
Yeah, in terms of overseas, I would say that Well, actually, globally, labor markets are loosening a little bit. That's been happening for well over a year. But if we look at the Eurozone in particular, its unemployment rate's still at a record low. Might be surprising to people, but it really has to do with the way that the labor market works there in terms of laws and the ability to be flexible on hiring and that kind of thing. So there's a lot of labor hoarding. Companies hold on to employees for a long time because it's very difficult to fire them, and then they have to hire them again. So they just kind of keep them. One thing I would say near term, we could see, U.S. companies maybe pull forward imports in expectation of future tariffs. So we could actually see an acceleration in manufacturing around the world, maybe in the near term. And then the other thing is that it's not a global trade war, even if we get a trade war, and there's reasons to believe not all those tariffs will be implemented. China could end up doing more trade with EM countries in particular, maybe even Europe. So there's some uncertainties here.
Yeah, for sure. Interesting point you brought up about the PMI. I mean, that's why I'm watching these PMIs very closely late this week because, yeah, you could see this ramp up in demand ahead of those tariffs and that could, more activity and all of that could boost those surveys. Market generally responds well to a positive PMI number, especially if they hook back up above 50 in the global. That's generally good news. It's not suggesting overheating in the economy that would raise inflation concerns, but it does suggest that the economy is coming back. You want an economy that's at least growing a bit here, particularly on the manufacturing side. And if you can get that at the same time, you can get easy financial conditions. That's usually a good environment for stock. So keep a close eye on that on Friday. Heather, what else?
The other question we have is regarding metals: gold, copper, silver. What do we have for expectation for that area?
So, as a sort of equity market strategist, which is mostly my focus, I don't spend a huge amount of time looking at metals other than, what they mean for businesses that use them, particularly gold and silver, which generally most of their demand is jewelry. 70% of, gold demand is jewelry. So it is what it is. Generally, when you have a strong consumer, particularly an Asian consumer in India and China, you tend to see that go up. But we've seen tremendous moves in silver and gold, and some of that has to do with the electronics. And there's like 20% of gold demand is for electronics, and so there's an element of that to it. But we're in an environment where the market is no longer sort of bracing for uncertainty. The election outcome is what it is. And so, generally gold tends to do well in an environment where geopolitical and political uncertainty is increasing, and that's not. So we've seen this drop in gold really since the election. A little bit of a bounce here in the last day or so for maybe a variety of geopolitical reasons, but for the most part, it's come down, and that is, just I think a direct result of that uncertainty fading. So there's that element. There's maybe relatively soft demand from consumers. There's also big central bank demand for gold that continues. That's not new. That's been ongoing. So there's a number of different cross currents there. In terms of base metals, copper and the like, that's really dependent upon the manufacturing recovery. And so if we see a stronger PMI number on Friday, again, as confidence comes back in the outlook and maybe even a ramp up in manufacturing activity and shipment activity ahead of the potential for tariffs next year, we could see a boom there, and that could draw more demand for, or expected demand for raw materials like some of the base metals like copper and the like. And so you could see a boost there. But I think in terms of gold, that was more concerns, ramping up into the election. Are we even going to know the outcome? How long are we going to be, lingering, not knowing the leadership in the U.S.? Obviously, that was all put to bed. And so, gold has slumped a bit on that. I think you'd need to see more of a ramp up in uncertainty. We had the U.S. give the Ukraine okay to strike longer range targets within Russia. So that's a concern. Obviously, we have Iran and Israel ramping things up, escalating things a little bit. So there's that element of geopolitics to all of this. So there's a number of different elements that could cause some volatility in gold prices. But I think in general, we've probably seen maybe a recent, a near-term peak anyway ahead of the election. And now you generally see gold prices slump a little bit post-election, and stocks tend to do a little bit better and outperform, just historically speaking. No guarantees, but generally you see, in the post-election environment, gold tends to soften up a little bit. So thanks for your questions. These are all really great questions, and we'll continue to make a lot of time for these questions in the shows going forward. So thank you. And thanks, Heather and Michelle, and Andrew and Gabe, and everyone for the questions again, and joining us each week, 11 a.m. Eastern. And of course, you can catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets in case we missed something. And we will see you next week.